Commerce Bank. Scott, you there?
Yes, sir.
Okay, so now we have this a bathtub full of mortgages.
Yep.
And somebody comes along and says, and there's a scene in the movie where they go to Goldman Sachs and he says, I want to bet against these mortgages. So now he wants to short the bonds. Mm-hmm. This had never been done before, and it is portrayed as Goldman Sachs, like these people laughing at this idiot who wants to short mortgage bonds.
Essentially, yeah, they were laughing at him because they wanted to short investment grade parts of this mortgage pool. At the time that they went to Goldman Sachs in 2005, there weren't many losses showing up. They were willing to pay even more money than Goldman Sachs probably thought they ought to be paying, and just figured that this whole thing was, basically, thought the whole thing was awfully screwy.
Right. So what did he do? What did he buy? What did he sell before he ever owned it?
What did he short, in other words, before he ever owned it?
Right.
He never sold anything. Okay, now this is where the confusing part is. So the big short is they went short the mortgage market in theory, okay? But they didn't short it. Here's what they went. Let's pretend you're worried about your house burning down, right?
Mm-hmm.
What do? You go to an insurance company, and there's a lot of them to pick from, and you pay them a premium, right? So that if in the odds, the rare occurrence that your house does burn down, they write you a big check. And you pay them a very small check, right? So my homeowner's insurance is a couple $1,000 a year. But if it burns down, all of a sudden they're going to write me a big check, right?
Right.
So essentially you went to Goldman and says, listen, I want to know what you would take. How much premium do I need to pay you so that if I picked a bunch of CDOs or a bunch of mortgage-backed securities and any of them blew up, you would pay me off at par. And eventually they worked out a deal where basically they were taking on certain bonds, all right, and they picked them out. The guys got to pick them out, the bonds they wanted to pick that they didn't like. And Goldman says, if you pay us 2% or 3% a year of the value of those bonds, we will guarantee that we will pay you off at par. Okay, so and a triple B rated security, which these were triple B rated bonds. So this was somewhere in the bathtub. It wasn't the top part of the water, but it's the middle part of the water, where basically the top part gets paid off first, and then the second part, that was that house they built out of the I call them Legos, or blocks of wood, where the AAA blocks were on top and the single B blocks were on the bottom. The triple B part of the market is that middle part of the market. And essentially you had to eat through all the lower blocks to make the triple B blocks go bad. But basically they were paying Goldman a fee. Well, that fee was 2 or 3% a year to sit there and wait for something bad to happen. And Goldman said, we've got another buyer on the other side of that will do this for a lot less, an insurance company. And Goldman just acted as the middleman. They found the insurance company directly, who originally was AIG, whether you know it or not. It was AIG. That's who Goldman went to sell them this idea, and AIG was willing to do it for a lot less than 2%, and so Goldman just took the middle part of that, right? The hedge fund was willing to pay 2% to insure their losses, and AIG says, there's no way there's going to be any losses on those bonds, I'll take that bet. And that's in essence the start of the Big Short.
Gotcha. Okay, that actually, my mind just sort of opened up. So basically, AIG said,
we're an insurance company. That
right.
bond is not going to go bad.
Right.
And you pay us 1% a year, we'll take on the risk.
So AIG said, don't buy the lottery ticket. You give me your $2 for your lottery ticket, and if you win, I'll pay you what the lottery would pay you.
Right. I'm in the business of insuring things. AIG was the largest insurer in the world. They thought they had a credit model. They said, these things aren't going to go bad. And AIG was ultimately proven wrong, right? We all know that now. And these three guys, these three different hedge funds, were ultimately proven right. They were a little early,
right,
as you usually are, and because they had to pay such premiums for so long, they were losing money at first, right? Because your house didn't burn down the first year. It didn't even burn down the second year. It took about 2.5 years for the house to really catch on fire.
Okay, so now Scott Colbert from Commerce Bank. Now it comes. Now the world has imploded. Lehman Brothers goes out. Bear Stearns is in trouble, or I guess Bear Stearns closes down. Lehman's in trouble.
Yep, Bear Stearns was sold to J.P. Morgan for essentially almost nothing.
So
and then Lehman goes bust.
Right, it's all collapsing. And in the scene, in the movie, They say, like, we bought these things, we don't even know how to sell them. Explain that part.
Well, I'm not sure exactly what part that would have been, but basically the banks also, when I say the banks, I'm talking about the big investment banks, the Merrill Lynch's, the Goldman Sachs's, the Lehman Brothers. They had a lot of this stuff on their own balance sheet, and they also believed quite a bit in the ratings. They also believed quite a bit that home prices wouldn't fall nearly as much as they did, and they didn't think they were taking on the risks because when you look at a bank's balance sheet, any bank, if it says AAA on it, you don't have to hold much capital against it. Even if it says triple B, you don't have to hold a ton of capital. It's not until you get into the weaker and weaker credits, and we all know now, in retrospect, that all these bonds were over-credited. They all had a higher credit rating than they really deserved, and thus there wasn't as much capital to support this entire market. And so when the prices started to fall, there were very few people to sell them to, as is usually the case, right? When the prices are going up, you can find tons of buyers. But when the prices started to fall, there were fewer and fewer buyers. A lot of people had bought this stuff on margin. There were margin calls, and so they were forced to sell securities. And I will tell you, the other half of this book that wasn't written are all the hedge funds that bought this stuff at pennies on the dollar post the implosion and made a fortune on the way back up because there were a lot of good securities, a lot of high-quality securities that were thrown out with the bathwater that were picked up for 50, 60, 70, 80 cents on the dollar that are all now back to par. So the second half of this is that psychology goes both ways, right? It went up too high. It certainly went down much too far, and a lot of these securities were worth something. They're always worth something. The key is just, not to overpay. And people at the top overpaid, and people at the bottom were given some big opportunities if you had the money to buy them.
So what is then, in all of this scenario, what is the credit default swap? Was that what AIG was buying to the hedge funds?
Essentially, that's a credit default swap is an insurance contract. And so go back to our GE example where you wanted to short and go long the GE stock. Okay, GE also borrows money, right? They have corporate bonds outstanding, one of the largest corporate borrowers in the country. A 10-year GE bond probably trades today at about 120 basis points off the 10-year Treasury. In other words, I can buy a 10-year Treasury for my bond fund right now, and it's riskless, or at least as riskless as you want to assume the U.S. government and the dollar is, right? But GE would pay you 1.2% more to borrow the money for 10 years, something about 3%. Well, I can buy that bond, right? I can buy that bond and take on the credit risk for 10 years, but I could also do this. I could call up Bank of America, and I can say, I don't really want to own the bond, but I want to own the risk for GE. What will you offer me in terms of extra income each year to take on the risk that GE defaults? And, theoretically, it ought to be about 1.2% a year. But because it's not exactly the same instrument, these things get, they get bifurcated oftentimes, meaning that the bond owners, the people who want to own cash bonds, are different than the people that want to own credit default swap. But owning a credit default swap is just like owning that bond. It's just that, you don't own the bond. It's a synthetic transaction.
Okay, so Scott Colbert with Commerce Bank. I'm I'm at the goal line. Mm-hmm. So the economy implodes, the houses prices drop, and now let's take Goldman Sachs as the bank. Goldman Sachs has these. They've just been a broker, but they've also covered these themselves.
Well, what they didn't say was a lot of the AAA securities they kept on their balance sheet.
Okay.
In fact, when they were selling these things, I would often ask, I said, well, who gets the AAA tranche? Oh, don't worry, that's been placed. The reason they kept that on the balance sheet was they could make so much money out of the junior pieces or putting them into a CDO, and they really did think that the risks were very minimal to own a AAA-rated asset-backed security backed by subprime mortgages. And, even the worst, just to be clear to the audience, even the worst AAA-rated, 2007 issued, most rotten in Denmark, subprime securities, as long as you had the bathtub where you started with the original product, you probably got paid 65 cents on the dollar, okay? So even the ugliest basket still paid you back 65 cents on the dollar. But you know what? A AAA bond's supposed to pay you back at par. Those are huge losses to a bank if you owned any of that kind of stuff.
So when the guys who shorted the market, who took out the insurance policies, when it all went down, it was almost like it was going down but nobody was paying. They weren't paying off the
Yeah.
insurance policy.
Well, here's when people first entered into credit default swaps, which is what this essentially was, an insurance contract. Who was in the middle? Bear Stearns, Morgan Stanley, Goldman Sachs. So really, you were dependent upon Goldman Sachs to make sure that the payment from AIG came through Goldman to you. But you're really still, your counterparty was Goldman Sachs or Morgan Stanley, which was, Goldman worked through this thing pretty well, just to be clear, and then to pick on Goldman. Morgan Stanley, though, was probably the biggest bulge bracket, firm out there that nearly went under. John Mack, they were the first people in line to take those TARP monies. So, depending upon your broker, and Bear Stearns, of course, was very lucky, and people that were dealing with Bear Stearns were very fortunate that J.P. Morgan ended up taking them on for $4 a share because J.P. Morgan's credit was superior to all these folks' credit because they didn't have these headaches going into the mess. They bought some of the headaches through the mess, and hopefully they've made some money now coming out.
So when it was all said and done, the TARP money then covered all of these insurance policies?
Basically, the TARP monies were created to put capital bank in the banking system. Capital, meaning, to cover the losses. Now, it wasn't directly dollar for dollar based upon the losses in the subprime space, but the losses in general were all coming from the mortgage-backed securities market. And so this TARP money that the government created and injected right into the banking system was to provide capital or a cushion so that the banks could absorb the losses, work their way through, and come out the other side. And by and large, I know TARP is a four-letter word to particularly the Fox News red meat-eating Missouri Republicans, but it did do its job. The government ended up not losing any money on the TARP program. Yes, they made it by basically putting in a backstop. And no one really loves the idea that some banks that probably deserve to fail did not fail. But at the same time, by saving the banking system, we may have all been, and it's a may, we don't know, but we may today all be better off. Let's put it this way. Aggregate mortgage debt outstanding, total mortgage debt in this country outstanding is not a penny more than it was back in 2007. So all of us today collectively have not borrowed any more money in the mortgage market, yet our incomes have grown 27%, our debt-to-income ratios have come down, and we're really in a much stronger, financial position today than we were in 2007. Now, we didn't realize how over-levered and how scary things were going into 2011. Hindsight helps a lot.
Yeah. Scott Colbert, last question for you with Commerce Bank. First of all, thank you for your time today because this has been an education. What about going forward? You mentioned it, but can we trust the rating agencies? Can we trust that this bubble doesn't happen again? Are there places and policies in place to sort of check and balance this system so it doesn't get out of control?
I'm not a pessimist. I'm an optimist in general. There's a in the book, and maybe even in the movie, they mentioned a guy by the name of Jim Grant, who, by the way, was just in town. He's a curmudgeonly guy who always looks back at history, and he's always a little bit pessimistic. He used to be an elf on Lou Rukeyser. They threw him off. But, he had written a lot of bad stories about how bad this mortgage market was going to be. And, he has a great quote where he says, the sum total of math and science is cumulative. In other words, the calculus adds to the differential equations and just keeps getting better, right? Science keeps compounding and getting better, but the sum total of finance is cyclical. And so we will go through another cycle and another time, and it'll be something different than what happened the last time, and it's just largely a matter of time. Will it be the same cycle? No, it's not going to be in the mortgage space because I'll tell you what, mortgage standard lending standards are a lot higher. Delinquencies are almost non-existent. It is tough to get a mortgage now. You have to verify your income and your assets. It's just, the mortgage market is healed. So where are the bubbles? Well, clearly we've seen the biotech bubble get popped recently, but there's not a lot of leverage there, but nonetheless there's a lot of equity investors in that. The high-yield market, there's been a lot of money in the high-yield market. That's rolling over. There's been a lot of money in the levered loan market. So we are seeing the signs of the end of this economic expansion start to show up. It's why there's people worried that, we might be heading towards the next recession, which always is, the cycle turns. I believe the credit cycle is turning. I think we've got a long run to go yet because really what I think is happening is we're handing off the financial part of the recovery, which has occurred. We've had the second longest bull market since, if you look back at all bull markets. We've had the third highest returning stock market per bull market. So, how greedy do we want to be? but we're now handing the financial football off to the real economy because job growth still continues. The average person now is beginning to recover a little bit, and probably it'll be at the expense of the hopefully the folks with the financial assets.
Scott Colbert, great as always from Commerce Bank. Thank you very much. You were a treasure and a treat, and I've learned quite a bit. Thanks, and we'll see you down the road.
Happy to do it, McGraw.
You got it. Thanks.
Bye-bye.
Scott Colbert with Commerce Bank explaining The Big Short. Wow, that was really interesting. 9:42 here, Big 550 KTRS. Let me tell you about Huber & Associates, because Huber & Associates is a St. Louis company. It's a Missouri company, and